Apparently bad news is good news. Live from New York City this morning. Good morning, good morning. Your equity market just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the calm after a global bond market storm as a GOP power struggle highlights D.C. dysfunction and Secretary Yellen suggests higher for longer isn't a given. We begin with the big issue, attempting to catch a falling knife.
Everyone's concerned about catching a falling knife.
A bit of a falling knife right now.
Given the fact that we've seen this sort of precipitous rise in yields.
This huge rise in Treasury yields.
Bond volatility has been the bogeyman recently.
You want to be a little cautious as to adding exposure.
We should have been more surprised if we didn't get this back up in yields.
Bond yields had to reset to this collapse of the recession narrative.
You've had a much more resilient growth environment.
It's really hard to know where we go from here.
The trend in yield is up until the market suggests otherwise.
Something has to happen to make more people want to buy more bonds.
You've got to see something which evidences a material slowdown in the economy.
Only do you see the yields start to come down once you see visible signs of economic slowdown.
Watch really closely for the upcoming non-farm payrolls because that could be the source of downside surprise.
When we start to see the labor market come under pressure, that will turn the tide for sure.
Joining us now to discuss, Invesco's Brian Levitt, Jim Bianco of Bianco Research. Gents, let's get straight to it. Treasuries rallying this morning, yields a little bit lower. Jim Bianco, is this a rally that you want to buy as well?
It's too early to say. I think it's more of a reaction that the 30-year hit 5% exactly overnight, and it probably dragged in some automatic buying. But I think that the fundamentals that caused this rally, meaning the end of the recession narrative and the strong data and the concern that we might be beyond the inflation story with the Fed talking about pausing, is still with us. So I would be more cautious on the bond market than thinking that we've hit some kind of peak.
It's super difficult, this one, Brian. How can you have any confidence the sell-off is over when there's so little conviction as to why yields are right up here?
I don't think you need to have absolute conviction that you're getting the top tick on the U.S. Treasury yield. I mean, what I see people doing right now is a lot of money in money markets, and they feel good about getting north of 5% in what they view as a risk-free asset. But I would say you do want to go out further in longer maturity Treasuries, into corporates, into municipal bonds, irrespective of whether you're capturing the low. The reality is you own these things to generate income over time, and what's presenting itself is a very significant opportunity. I mean, a 2.5% real yield on a 10-year Treasury is a very attractive proposition. So, whether or not you're right on the next 10, 15, 20 basis points in the short term may feel painful, but if you're a intermediate or longer term investor, the ability to compound these yields to me looks quite attractive.
The problem is, Brian, the 2 years still at 5, the curve's still inverted. I know we've done a lot of work there. It's not as inverted as it was, but given it's still inverted and the economic data is still okay, what's the real incentive to go out along the curve?
The real incentive is the reinvestment risk. And so no one's going to ring a bell. Everyone hears the Federal Reserve speakers saying we're going to stay high for longer. Well, the Federal Reserve doesn't want to ring a bell and have us all feeling like financial conditions are going to ease a lot. So they're never going to tell you they're done. But ultimately, after 550 basis points of rate hikes, by the way, 18 months ago, the Fed funds rate was 0, you're still going to see some of the lagged effects of all of this. So the economy is likely to slow. If you look at the futures market, they expect the Fed funds to be 4.5% by the end of 2024. So that's when the reinvestment risk starts to happen. Typically, when you have an inversion in the yield curve, the economy rolls over and the Fed eases. And people historically have gone to the short rate. And typically, you can look at 2000, you can look at 06, you're better off going long in those environments. Now, again, no one's going to ring a bell. We don't know which day this is going to happen, but ultimately, short rates will start to come down ahead of the expectations that the Fed's going to start to ease.
Jim Bianco, what would you say back to that?
Well, one of the things I'm more concerned about, or am concerned about, is we're anchoring ourselves off the 2010 to 2020 period, when the market was unusually low, when real rates were negative, and that might be the outlier. And what we're seeing now is more of a return to normal. There's a line going around that basically we were in a sugar high between 2010 and 2020, and it created market and the Fed created market and economic diabetes. And now that we're taking the sugar away, we've got a hypoglycemic economy. Forgive me for this metaphor. And that what we're seeing happen here is we're looking at these levels and going, they're very high. Real rates at 2% are very high. That's actually the 50-year average for real rates is 2%. It was those rates from 2010 to 2020 that were unusually low.
Jim, I was never going to jump in and cut that off. I was enjoying it. Truly, I was. In the bond market right now, yield's a little bit lower by 5 or 6 basis points on a 2-year. Certainly not the trend over the last couple of days on a 10-year. Back-to-back double-digit gains on a 10-year yield Monday, Tuesday. The data good on Monday. The data good yesterday. It was the ISM manufacturing, then it was job openings. The data this morning, downside surprise with that economic information. Here's Mike McKee. Morning, Mike.
Good morning, John. Well, what is it really telling us? That's the thing you always ask with ADP. They report only 89,000 jobs created in the private sector over the past month. And that seems quite low given the strength in the economy. We'll have to see how it plays out because over the past year, ADP has overstated the private sector job creation 7 out of the 12 months. So if that follows, then we will have an unusually weak payrolls report on Friday. But hard to square with what we saw from the ISM manufacturing numbers because ISM went positive and ADP says we lost 12,000 jobs. It all is the thing. All this kind of plays into the bond markets and what is going on. You guys have been talking about it here. If you deconstruct the 10-year, you can see kind of where the issue is. It's not that markets think that the Fed is losing control of inflation, but there is a term premium increase going on. It's not huge, but only about 22 basis points. But it does suggest that there are other factors out there that are influencing traders who are worried about something. What exactly that is, it's hard to say. It makes a difference because the inflation premium is usually thought of as the monetary problem for bond traders and the term premium thought of as maybe a fiscal problem. Does that mean that people are really worried now about what's going on down in Washington? It could be. Janet Yellen asked yesterday if these rates are going to stay high in this area and keep pressure on the government, which has to spend more money to pay interest costs. And she says the answer is, I don't know. It's a great question, and it's one that's very much on my and the administration's minds. So this is the great unknown at this point, and it maybe comes down to the idea of the Fed raises rates until something breaks. Is something going to break? We don't know what it is. Got to say, John, I love Jim's analogy. And, you know, they're treating diabetes now with Wegovy and Ozempic, the weight loss drugs. So we could solve 2 problems at once.
We could.
I can lose weight and the markets can calm down.
We can feed the bond market or inject it with Ozempic or whatever it is. Mike McKee, thank you, sir. Something did break earlier this year. It was the financials, some of the banks. Jim Bianco, what is going on with the nation's banks? If you pick out 2 charts, Citi, Bank of America, those charts are ugly. We're trading through the spring lows for many of those names. Jim Bianco, what's going on with financials in America?
Well, I think that they're really stuck with a big profitability problem, and that's from what has been termed the bank walk. People, you know, we have mobile banking apps now, 120 million people a month use them, and they're looking at, you know, deposit rates still around 1%, if not less, and they could pull their phone out of their pocket and they could move to a money market fund and get 5.5. So you're constantly seeing this bleed of deposits out of the bank. It's actually now banks have lost 10 or 11% of their deposit base in the last year or so, which is one of the largest drawdowns we've seen, and data goes back to the mid-1970s. This doesn't mean that we're going to have a bank failure or that your money's at risk, but it does mean that the profitability of the bank is at risk, and that's why we're seeing these banks start to fall. And yeah, if you're not Chase, it seems like everybody's either wants to put their money in Chase or wants to put their money in a money market fund, and everybody else from the regional banks all the way on up seem to be suffering a lot more.
Bank of America down 22% almost year to date. Brian Levitt, Jim's right to make that distinction. The difference between a profitability issue and an existential crisis. Can we talk about one versus the other? Brian, do you see a risk of a repeat of what we saw in spring? Or have authorities, policymakers done enough to insulate us from that, even with these big monster unrealized losses in the Treasury market?
Well, they certainly helped to calm the situation from where we were in the spring. I think the critical thing is to differentiate, I think, for most investors from 08. This is not a challenge of banks sitting on, significant piles of bad loans that were made. I mean, the capital ratios of these banks look quite strong, but there's certainly likely to be continued challenges at banks with regards to their interest rate exposure and their inability to hedge that exposure. So I wouldn't be surprised to see a few more challenges arise. I don't expect it to be anything severe like we've seen in past crises, but you typically see these tightening cycles end with some type of an accident. We've had a few accidents here, and policymakers have stepped in. I think it would be a surprise to not see a few accidents again emerge with the amount of tightening that we've seen in such a short period of time. It's largely, Jonathan, why I believe that you'll ultimately see interest rates come down. When you get to these periods, there's this recency bias that hits our heads, say, well, it just happened, rates gone up, so they're going to stay up forever. The reality is, what's really changed structurally around the world from where we were during what Jim had called the sugar high, 2010 through 2020. Sure, COVID created some trends towards deglobalization, but European economy is weak. China and Japan have demographic challenges. U.S. economy still largely in the same place in terms of growth potential. So ultimately, I expect interest rates to come back down. Now, yeah, real yields will be higher than where they were in the past cycle, but I expect rates to moderate as challenges emerge and as the Federal Reserve has to back off its tightening stance.
Jim, what's changed?
Oh, I think what's changed might be that we are in a post-pandemic economy, and that's a fancy word for saying that the labor market has changed. Remote work is a big thing. Deglobalization has changed. We're seeing energy, especially among Russia and OPEC Plus, being used more as a political weapon. And all of that's filtering into higher inflation. Now, as I like to say, it's not 8, 10 Zimbabwe inflation, and I don't think it'll ever be that. But if it's 3% or 3.5% is the long-run rate of inflation, as opposed to 2%, then you're looking at like the 10-year note having a 4.5 as fair value. Okay, it's above it now and it's restrictive, but it's not nearly as restrictive as we think it would be if we're still using the metrics of, say, 2019, when maybe the fair value was closer to 2 to 2.5%. So I think what's really changed is this sticky inflation and this long-run inflation rate that I think is closer to like 3, or it has somewhere in the 3 to 3.99 handle on it.
It raises questions about how reliable this bond market is. Is any signal about where this economy is going with that in mind? Brian, I know you want to jump in, so please do.
If you look at the core personal consumption expenditure numbers over the last 5 months, which of course is the Fed's preferred measure of inflation, and you annualize the run rate, you're looking at about 2.5% inflation, which is very much in line what the 5 and 10-year break-evens are telling us. So what was astutely noted earlier is that this is not an inflation expectations problem. This has been a move in real yields. So expectation that growth, or the reality that growth has been stronger than many people expected, compounded with some of the challenges in D.C. My point is to say that, do I believe that we're going to go into a period of sustained higher growth around the world that would keep real yields at 2.5 or north of that? And I don't. So perhaps you get back to, to Jim's point, more the average real yield closer to 2%, which is why I think interest rates come down from here, because I don't see what the catalyst for higher sustained growth is in the world. Again, I pointed to Europe already likely heading towards a recession, China and Japanese demographics challenged, and the U.S. still largely being the same place that it was from a growth potential perspective, before we even thought of the word COVID.
Hey, Brian, thank you. Brian Levitt, Jim Bianco, going to stick with us. We'll keep arguing about this. About 16 minutes away from the opening bell. Futures positive here on the S&P. Let's get you some movers. Here's Abby.
And beneath the surface of those small gains to the upside, John, we do have some bigger movers, starting out with the shares of Palantir, the data collection company, the technology company. It is popping higher on the news that they are closing in on a controversial UK health data contract, basically one that will collect the health data of many folks living in the UK for the National Health Service. Investors, though, like the possibility of that revenue coming in. Intel, in an interesting move, up 2.6%. They are basically spinning out their Altera unit, the PSG unit. They will be seeking either an IPO or a private investor as they continue to streamline and transform their business. And then KeyCorp, you all were talking about what broke a little bit earlier this year. Well, KeyCorp did fall. A regional bank fell 50% earlier this year on the Silicon Valley Bank mess. Now it is trading higher as Wolf has upgraded it to a peer perform on rates benefits.
Abby, thank you. Coming up, a GOP power struggle leading to more dysfunction in D.C.
I believe I can continue to fight, maybe in a different manner. I will not run for Speaker again. I'll have the conference pick somebody else.
Team coverage next.
You all know Matt Gaetz. You know it was personal. It had nothing to do about spending. It had nothing to do about everything he accused somebody of he was doing. It all was about getting attention from you.
It's the benefit of this country that we have a better Speaker of the House than Kevin McCarthy. Kevin McCarthy couldn't keep his word. He made an agreement in January regarding the way Washington would work, and he violated that agreement.
Goodbye, Kevin McCarthy. Hello, uncertainty.
The yeas are 216. The nays are 210. The office of Speaker of the House of the United States House of Representatives is hereby declared vacant.
Kevin McCarthy ousted from the speakership in a rare maneuver after GOP hardliners revolted over his shutdown compromise. His removal fueling concerns about more turmoil. The House set to hold speaker elections next week, and the next government shutdown deadline looms November 17th. Let's get to the team coverage. Bloomberg's Anne-Marie and Kelly Lyons in Washington, D.C. AMH, who's next?
Well, we're in uncharted territory at the moment, Jonathan. And, you know, what we heard from French Hill early on your program in Surveillance, he was saying only 4% of the Republican caucus voted for this. So there is, you can see that the majority of the Republicans actually wanted Speaker Kevin McCarthy to remain in that position. He's now no longer their speaker, and there's a bunch of names being floated around, and those are the faces right there on the screen. Steve Scalise, he's apparently been making some phone calls, Jonathan. The issue is he has multiple myeloma. This is blood cancer, and he's being treated for it. Now, yesterday in the halls, he said, listen, I feel great, but also, is he too much of an establishment figure? Remember, he was the deputy to Speaker Kevin McCarthy. Then there's Tom Emmer. He's part of the leadership team. You have Patrick McHenry, who is the pro temp right now. He is the interim speaker. His job, his only job right now, is to make sure the Republican caucus can get a speaker that they can get 218 votes around. Other names like Elise Stefanik, and then there's Jim Jordan as well. Now, Jonathan, he told Joe and I on Balance of Power Monday evening before this motion to vacate that he does not want to be speaker and he fully supports Kevin. But now maybe he's going to be looking into it because Kevin is no longer in that job.
Kelly, with all of that in mind, is a shutdown now just inevitable?
Well, of course, we're working against a clock here, Jonathan, a deadline of November 17th. The government funding that was agreed to in the continuing resolution of last weekend that led to McCarthy's downfall in the first place only extends to that date. And the issue is right now we have paralysis in the House. As Anne-Marie was just saying, really the only thing that pro temp Patrick McHenry can preside over is a speaker vote. He can't preside over usual business. And that speaker vote isn't even scheduled to happen until next Wednesday, October 11th. And if you recall, John, the first time around when McCarthy was elected speaker, it took 15 rounds and 4 days to get it done. So we could be looking at a protracted fight here once again, and that will start running the clock, and we won't be working on these appropriation bills. Remember, 12 of them need to be passed in total, and they need to be reconciled with the Senate, and that will be the difficulty for whoever does ultimately get the speaker's gavel, because they're going to have the same issue of trying to reconcile conservative hardliners' priorities for deep spending cuts with something that can pass in a Democratic-controlled Senate. And that job is really tough, as we have just seen play out, John.
What a mess. Kelly Lyons, AMH, to the both of you, thank you. Tremendous coverage, as always, in Washington on Balance of Power at 5 p.m. Eastern Time. Brian Levitt, Jim Bianco back with us. Jim, is there a fiscal risk premium in this bond market?
I don't think there is at this point, because if you were to look at what a shutdown would be, it's bond bullish. It would either slow the economy, put the economy at risk, or if it lasted long enough, you would actually be talking about less supply because the government would be shut down and wouldn't be spending as much money. All of that should actually lead to a rally in the bond market, but as of 3 hours ago, the bond market had not been rallying through any of this. So I think it's looking past it. And let's not forget that in May, when we were all worried about the default, and last week when we were all worried about the shutdown, we had 11th hour agreements in order to prevent those. So there's nothing to stop us from having another 11th hour agreement around November 17th, maybe another continuing resolution. We did that for entire years in the early Obama administration. We never had a budget. We just went one continuing resolution after another to keep the government open.
Brian, can you connect the dysfunction in Washington with some of these bond market moves? Other people have. Would you agree with them?
I think it's a challenge to do that. I think the bond market has largely been moving on better than expected economic activity. I agree with Jim that, you know, if there is this type of chaos or uncertainty and inability to get spending bills, that would probably lead to some form of flight to safety, ironically or paradoxically. I come back on all of this to the Churchill line. I don't know if he said it or didn't say it, but Americans always doing the right thing, but only after exhausting all other options. So I am very much with Jim on this one. I don't think investors historically have done very well investing based on their political hopes or fears. Far better off watching what's going on in the business cycle, far better off watching what the Federal Reserve is likely to do, rather than spend a lot of time worrying about these 11th hour deadlines, or these deadlines that we always overcome at the 11th hour.
Let's hope we overcome it again in the not too distant future. Brian, thank you. Brian Levitt, Jim Bianco, to the both of you, thank you. Coming up, the morning calls, and later, Cboe's Mandy Zhu joins us around the opening bell to discuss the impact of higher rates. That conversation just around the corner. Your opening bell, 7 minutes away. Inching towards the opening bell, just pulling back a little bit on the small caps, but other than that, we're positive here. Bad news is seemingly good news. Apparently, on the S&P, we're up by about 0.1%. That's the price section. Let's get you some morning calls. Your first call from KeyBank, downgrading Apple to sector weight, highlighting the stock's rich valuation and weakening sales outlook. Their stock is negative by 0.6%. Next up, Citi upgrading Leondale Basel to buy, seeing upside as margins continue improving throughout the next year. That stock is up by 2.4%. And finally, Piper Sandler downgrading B&G Foods to underweight, pointing to weakening sales trends and inventory concerns. We're down there by more than 5%. Up next is Cboe's Mandy Zhu, joining us at the opening bell, discussing the stocks and sectors poised to feel the most pain from higher rates. Your opening bell up next. 25 seconds away from the opening bell this morning. Good morning to you. Pulling back yesterday on the S&P 500 to the lows of early June. Trying to bounce this morning by 0.1% on the S&P. On the Nasdaq, up by 0.3. Trying to turn this bond market upside down after the sell-off recently. Trying to rally. Your opening bell rings in New York. Switch at the board and get to the bond market. Your rally in the Treasury market looks like this. Down 3 basis points on a 10-year. 4.76 overnight, reaching 5% on a 30-year yield. And then backtracking. The data good on Monday, good on Tuesday. Downside surprise this Wednesday morning on the ADP report. In the FX market, it means yields down, dollar weaker, euro stronger, 105.14. Call it 105.15. That currency pair positive by 0.5%. Crude backtracking lower, negative after a big rally over the last couple of months. We're down by 2.3%. $87 and about 15 cents on WTI. About 30 seconds into this one on the S&P, we advance up by 0.1%, on the Nasdaq up by 0.2. One stock to watch at the open is Intel, announcing plans to separate its chip division into a standalone business. The company writing in a statement, "We intend to conduct an IPO for the unit and may explore opportunities with private investors." Abby has more. Hey, Abby.
Hey, John. Yes, so we have this story that Intel is separating this purchase from Altera back in 2016, so they haven't had it all that long. It's called the Programmable Solutions Group, or short is PSG, and they're basically going to put it into this standalone business either through an IPO. They will be looking for private investors, as you mentioned, and it's really the shift that we've seen in the landscape. Now, this stock has basically been in a range going all the way back to 2000 between about 80 and let's call it 30 or so. So a very wide range. But unlike most other tech stocks, Intel hasn't put in a new all-time high since the tech bubble. So clearly, investors probably want them to do something to revamp their business. Analysts are relatively positive on this move, saying that it's a prudent move to unlock shareholder value and raise cash. One of our BI analysts is saying something similar, that it bolsters capital resources for the company's pivotal investment in the Intel Foundry business, the quote-unquote North American star. So shares are responding relatively well today, up 1.6%. We also, on the year, have Intel up about 35%. What makes that really interesting, John, I would have guessed that Intel would be underperforming the SOX, or that chip index, but they're actually, right in line there. So the SOX up about 34% on the year. Intel might even be gaining at this point. So investors like these changes that they're making.
Up something like 1% this morning. Abby, thanks for that. Let's turn to big tech. CEO Tim Cook selling more than 500,000 shares of Apple, taking in roughly $41 million and its biggest sale in more than 2 years. KeyBank downgrading shares to sector weight, writing this: U.S. sales are likely to struggle and it's still trading at a large premium. Isabel Lee has the story. Hey, Isabel.
Hey, John, that still leaves Apple's Tim Cook with around 3.28 million shares, according to data compiled by Bloomberg. And the share sale, this is rare. It came after there was pushback around his compensation. This was announced in January this year, when Tim Cook was earning around $100 million in 2021 and 2020. And as a part of the changes, his stocks award tied to Apple's performance will also increase by 75% from 50%. Sticking with Apple, as you said, the company was downgraded by KeyBank. KeyBank is saying that Apple is trading at near all-time high valuations, but its sales growth is likely to slow. In addition, international growth expectations for reacceleration may be aggressive, and we see the stock softening to around 0.3%. Still, shares of Apple are up around 33% this year, but it has retreated somewhat from its all-time high in July to around 12%. Now the stock is down around 0.3%, John.
Thanks for that, Isabel. Stock a little bit softer. I want to turn to Ford, slightly negative today in early trading. Some numbers from them on third quarter EV sales, up around about 15% year on year. This one jumps out. Electric F-150 Lightning sales fell 45.8% in the third quarter. The latest from Ford there. F-150 Lightning expected to produce sales increases in 4Q. Those numbers dropped in the last 30 minutes or so. Let's stick with tech. Palantir has emerged as the top pick for a contract to overhaul the UK's National Health Service, drawing some controversy. Simone Foxman has this. Hey, Simone.
Yeah, John, this was a Bloomberg scoop that came after the bell yesterday. Sources tell us that the Palantir, the winning bidder, could be announced as soon as this month. Of course, still subject to some final approvals, some legal arrangements. Now, this is less about the size of this specific contract than the potential for this to be a forerunner of future contracts with governments. The firm's on track for a $1.26 billion in government sales this year. This deal over 5 years is about 480 million pounds, so $580 million, give or take. But as you mentioned, it has been extremely controversial. Most of these concerns have focused on data privacy. It was found, and according to leaked documents in 2020, that the company was allowed access to sensitive data about patients, employees, members of the public, things like political affiliations, religious affiliation, past criminal offenses. There was also criticism about the company's attempts to buy its way in to winning this NHS health deal. There was lots of hype in the summer for Palantir's shares hitting a peak in August, but we've seen that mitigate recently. Still, the name up about 140% this year. We're seeing some enthusiasm here, some positive catalysts, up close to 2.9% in trading today, John.
Simone, thank you. Not seeing much enthusiasm with the banks. We all know about the issues we had earlier this year in spring. Let's talk about where we are year to date now. Bank of America is down 22% year to date. Morgan Stanley's off by something like 8 or 9. Citi really struggling. These charts are ugly. We're down about 12% on Citi. If you look at Bank of America and Citi, both of those names are trading below the post-SVB failure lows. KBW Bank Index not doing too much better either, going into earnings season. 2 Fridays away, it kicks off with JP Morgan results. We talked a lot earlier this year about unrealised losses in the bond market. I can tell you, in the Treasury market, if you're sitting on any of those bonds, those unrealised losses have got a whole lot larger. Wolf Research upgrading KeyCorp to peer perform with this to say, at least some good news on this front. We now see a greater likelihood of higher for longer rates extending well into 2024 and expect shares to enjoy greater tailwinds. Katie Greifeld joins us for more. Now, Katie, I think this raises a really big question. Are high yields good or bad for banks?
Maybe when it comes to net interest income, and that's really the basis of this call. KeyCorp is rising a little bit after that upgrade to peer perform, and Wolf basically sees KeyCorp catching up to its peers. Other banks, they did benefit earlier in the cycle from rising rates in terms of that net interest income before those higher rates became a little bit punishing. And that tailwind, though, it was relatively muted for KeyCorp due to the bank's hedging activities. But Wolf now expects that KeyCorp's 2024 results will be materially higher, relative to its prior expectations. You can see that's giving a little bit of a lift to shares, but as you laid out, John, it's been an absolutely bruising run for these bank stops. The KBW Bank Index, just zooming out a little bit, it's dropped 16% from the start of August, of course, as yields continue to soar. It's down more than 25% so far in 2023. A lot of those losses coming in March. And if you take a look at KRE, that's the regional banking ETF, it's sitting on 32% year-to-date losses. And I'll point out, John, that short interest on that ETF is back to levels that we last saw in March.
Wow. Katie, thank you. Thanks for the update on all of that. The spotlight back on the financials, the spotlight back on the banks, for all the wrong reasons going into earnings season. Looking ahead to JP Morgan 2 Fridays away. The week after that, you'll hear from Bank of America. Let me get you another view on the south side. This from Evercore, weighing in on the banks ahead of those results, saying this: we expect third quarter results at the banks to reflect a leap out of the frying pan and into the fire. The rising 10-year yield is putting unrealized losses back on the radar. Think about where this bond market has been. 150 basis points higher from the lows post-SVB, 150 basis points higher, from something like 330 all the way back up to something like 480. Joining us now to talk about some of this, Mandy Zhu of SIBO Global Markets. I'm pleased to say she joins us now. Mandy, let's talk about it. Is this bond market move we've witnessed over the last couple of months enough to wake up the VIX?
So my short answer is going to be no, not necessarily. And the reason for that is what is driving bond yields higher this year is very different to what was driving it higher last year, right? So last year it was very much about runaway inflation. It was very much about aggressive Fed action, potential over-tightening leading to recession. And that's why if you look at the yield curve, what was driving rates higher last year was the front end of the curve. And even as traders were pricing in more aggressive Fed action, they were also pricing in very steep rate cuts coming down the line as well because of lack of confidence in the economy. This year, fast forward to now, what we're seeing is very much actually the yield curve move is very much driven by the back end, right? Inflation has come down, the labor market has remained resilient. People have become more confident in the Fed's ability to hold rates longer, higher for longer. And as a result, these are all very positive factors for equity markets. So to me, at the index level, this is not the catalyst to really drive VIX into a much higher regime. But underneath the index surface, at the stock and the sector level, I do believe higher rates will continue to drive those gyrations and the rotations underneath the index surface.
Mandy, as you know, I've read your work for a long, long time. This word that often pops up, dispersion. Can you walk us through what dispersion actually means and what you're seeing currently?
Yes, so dispersion is a very fundamental measure of just how much stocks are moving relative to each other. And the reason why this matters is, if you think for an equity investor, long-short investor, dispersion essentially tells you how much alpha there is to be had from stock picking, right? In a low dispersion environment where there's not much variation between the stocks, there's not much P&L that you're going to be able to generate from stock picking. In a high dispersion environment, that's going to really start to grow. And what's really tricky is that dispersion as a risk metric has historically been fairly hard to abstract and fairly esoteric. So what we've done at SIBO, actually, we launched last week a dispersion index. So the S&P 500 dispersion index, ticker DSPX, that's going to allow investors to track dispersion in a very transparent, easy to follow way. And importantly, just like the VIX index, it's a measure of implied dispersion. So how much dispersion market expecting for the next 30 days going forward.
So Mandy, let's finish up with this one. Favorite idea right now? What are you advocating for?
So I do, again, like going back to kind of the fundamentals, I do still think this is going to be a sector rotation market. It's going to be a strong stock dispersion environment. To me, really, for those looking to play that upside in the VIX, you're going to need an unknown catalyst, right? But if we go back to the VIX, one thing that I've been highlighting that we have seen in terms of pickup in activity is those buying of those upside calls. People are starting to get nervous in an environment where VIX is kind of in the mid to low teens, or despite the pop recently, starting to get nervous that the soft landing narrative is becoming too complacent. So we have started to see very strong pickup in activity in those VIX upside calls. But to me, to get that VIX pop, you need something more than just higher rates, because that is still very much a fundamental catalyst. It's not a macro catalyst that's going to drive volatility higher.
Mandy, thank you. Let's catch up soon. The latest from Mandy Zhu there of SIBO. About 11 or 12 minutes into this session, equities up here by 0.3%, on the Nasdaq up by 0.6. Big downside surprise on the ADP report. A little more data a little bit later. We'll get a PMI and ISM services read for you in about the next 20 minutes or so. Looking at the bond market, post ADP report, yields drop in, down about 4 or 5 basis points on a 10-year. Let's call it 475. I think from the higher the session to the lower the session, we've had a range of about 15 basis points on a 10-year yield. Still some way to go to get through today's trading day, with a few more data points still to come. We'll catch up with Mike McKee in just a moment. Coming up, strikes emerging everywhere.
The reality is there is a real wage pressure problem, and this wage story is a big thing. Everybody hears it all the time. So that helps drive the momentum behind, yeah, I deserve to get paid more.
That conversation up next.
The reality is there is a real wage pressure problem. And even though there's a smaller percentage of the economy is unionized now than back last time we had a significant wage-related issue in the economy, the fact that we have 24-hour a day, 7 days a week, 365-day-a-year financial press, and they're looking for things to talk about, and this wage story is a big thing, everybody hears it all the time. So that helps drive the momentum behind, yeah, I deserve to get paid more.
They're going to hear more about it now. Here's the latest. Ford delivering a sweetened offer to UAW leaders, including a wage increase of more than 20%, a deal that would launch its workers into the top quarter of all U.S. jobs. The Ford CEO, Jim Farley, writing this: "We've put an offer on the table that will be costly for the company, given our large American footprint and UAW workforce, but one that we believe still allows Ford to invest in the future." This is Ford and GM lay off about 500 more employees, citing the expanded strike, now in its 4th week. Let's get the latest from AMH in Washington. Morning, Anne-Marie.
Good morning, John. What we're seeing here from Ford is they're saying this is their 7th and the strongest offer to the UAW, especially that 20% wage increase. The issue is our Bloomberg News colleagues have reported that these UAW workers do not want to emerge from a strike without a baseline of a 30% wage increase. So will this be enough? Also, we do have, and we have been discussing on this program a lot, the issue of the electric vehicles and the fact that this is the bedrock of a lot of anxiety and consternation within the UAW. And this is what the Ford CEO had to say about that. Quote, "While Ford remains open to the possibility of working with the UAW on future battery plants in the United States, these are multi-billion-dollar investments and must operate at competitive and sustainable levels." So they kept their position on they will be willing to work with the UAW on potentially some of these jobs, but at the same time, they need to make sure that they are a profitable company. That's where it looks like for Ford, Jonathan. This does look like a strong offer. We do not have a response yet from UAW. But look at what GM is doing this morning. They need a $6 billion credit line For me, that says that GM is expecting these strikes to go on for longer, and it sounds like it's going to be painful.
MH, thank you. Mike McKee, let's talk about further strikes as well, not just UAW, but Mike, we've also got strikes in the healthcare sector today.
Yeah, and they're not going to show up in the jobs numbers on Friday because the BLS has already put out its strike report, and they find only 17,000 workers on strike, none from the auto companies. And of course, the nurses just went out today. So look for October data, the first week of November rather, to reflect that. But at this point, it doesn't look like we're going to see a lot of impact on hiring. We will see the impact on jobless claims in weeks to come, however. We also have a couple of numbers here that just came out, John, the Standard & Poor's Global Services PMI and Composite PMI. They are essentially little change. The services PMI goes down a tick to 50.1 and the composite goes up a tick to 50.2. They are suggesting things are positive out there. But let's wait till the top of the hour. We get that ISM services index. Everybody's going to be looking at the jobs numbers because in the manufacturing numbers on Monday, we saw a gain over 50%, so over 50. So that suggests expansion again in employment in manufacturing, and in services, we'll see. That may have more of an effect on people in the markets if we get a big number than ADP did this morning.
Mike, let's talk about the data so far this week. ISM manufacturing on Monday. Tuesday, they had job openings coming in much higher than expected. Big downside surprise on ADP this morning. We always talk about a mosaic of the data. I think Andrew Hollenhorst, the city, was talking about that, Mike. How much weight would you put on each data point we've had so far this week?
I think people put the most weight on the ISM numbers. They tend to reflect a little bit better in a directional sense where we are. The ADP numbers don't have a very good correlation with jobs anymore, and they don't pretend to. But we do know that ADP has come in stronger on private payrolls for the last 5 or 6 months in a row than non-farm payrolls. So we could see maybe a weaker number, but hard to really put a lot on that.
Mike McKee, thank you, sir. The latest on the economic data. If you missed it a little bit earlier, 89,000 was your downside surprise on the ADP report. The number we were looking for, 150,000. 150K was the median estimate in our survey here at Bloomberg. So that's a big downside surprise. As Mike McKee indicated, for some of you I know, it's almost like the bad tasting appetizer for the payrolls report. Comes early just before it, but maybe it doesn't really give you a guide to what you're about to get afterwards. Speaking of what you're about to get afterwards, payrolls on Friday, the estimate at the moment could change between now and then. 170,000 currently. That's the estimate. The previous number, 187. For the broader price action, we look like this about 21 minutes into the session. Your equity market on the S&P 500 just about positive by 0.2%. On the S&P, on the Nasdaq up by 0.5. This after that downside surprise on the ADP report triggered a bit of a bond market rally for treasuries. Real turnaround. Think about it. The 30-year had gone through 5% in Asian trading, then turned all the way back around again. It's down about 4 or 5 basis points to 488. The 10-year yield was having a little look at 490, just short of that level earlier on today. The 10-year now 475. Down about 4 basis points as well. Let's get you some broader sector price action. We can do that with Abby. Hey, Abby.
Hey, Don. Well, with just a small gain for the S&P 500, we do have more sectors trading higher than lower, led by consumer discretionary. Amazon, a big boost there, up about 1% on the day. Materials, tech, communication services, real estate, utilities, and consumer staples all higher. To the downside, energy down 2.4%. There's been a stealth $7 drop in oil since last Thursday. John, WTI crude is now at 86, 87 or so, at least stealth to me. It's going to be interesting to see how that plays out for the risk assets overall. And then if we take a look at what you've been talking about all morning, weaving it into the story, the banks, the regional banking index on the year, basically near those March lows after the blow up of Silicon Valley Bank and some of those other regional banks, down 27% right now if these declines stay in place. And actually, I should say the year-to-date decline is actually 33%. The chart we're looking at, down 27%. The worst year ever since this ETF has been in place since 2007, John.
Brutal stuff going into bank earnings, as I've said repeatedly, kicking off on October 13th. Friday the 13th, 2 Fridays away, with JP Morgan results just around the corner. Coming up next, we'll get to the trading diary. The calendar absolutely packed going into payrolls on Friday. I'll give you a sneak peek up next. 25 minutes into the session, equities higher by 0.25% on the S&P 500, rebounding this morning as we start to rally in the Treasury market. Get to Treasuries, 2s, 10s and 30s lining up as follows. Your 10-year higher the session, just short of 488, right now down 5 basis points to 474, following that downside surprise on the ADP report. At the long end of the curve on the long bond, the 30-year, very briefly, just north of 5%, all the way back down about 6 basis points on the day now to 486. The turnaround, the data at the epicenter of it. More economic data still to come. That's the price action. Here's your trading diary. Coming up very shortly at the top of the hour, ISM services, along with Fed speak from Bauman and Goolsby. Then, a little bit later, we'll get opening arguments expected in the Sam Bankman-Fried trial. Thursday, another round of jobless claims and more Fed speak from Mester, Barkin, Daly and Barr. And Friday, it's your payrolls report. It's just around the corner. And your estimate currently is about 170,000. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.